Hello, very good morning to all, and I'm Kelvin here again. I hope that you guys have a wonderful and restful weekend and all prepared for these upcoming Chinese New Year festive seasons. So before we start our daily dose of market insights, very good morning to all of us. Today will be a brand new week, 27th of January 2025, Monday. So as usual, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so let's have a quick recap first. As usual, what has taken shape in early Asia session today and as well as over the weekend in terms of relevant news flow and as well as their impact on the various broad-based cross asset classes. All right, so in terms of news flow, there are actually two that I will share with you all. Firstly is over the weekend, there's this announcement by China regulators to actually kind of increase, or I would say that put in a way that they actually attempt to increase the stock trading activity of the mainland China stock market. So over the weekend over here is that what they did, the regulator actually approved 52 billion yuan, which is equivalent to USD 7.2 billion for insurers. That means we talk about China insurers, like potentially the major one like China Life, long-term equity investment. So what they do over here is that they allow this we call it insurance firm in China to have a more cash holding as being deployed to the local A shares market. So that actually created a positive feedback loop in today's Asia session, where we start to see the Hang Seng index or the Hang Seng indices, if we look at the HSCI as well, continue to actually rally from last Friday positive closing. So if you look at the current state of affair in the Hong Kong stock market, where we see across the board positive performance as we are speaking right now across the Hang Seng stock indices, ranging from, oops, why is it, okay, give me a minute, sorry about that. I don't know why it's suddenly kicked me out. Okay, let it run for a while. Okay, as you can see in my watch list over here, all the Hang Seng indices are in the green right now as we are speaking. The HSI is up 0.7%. The higher beta Hang Seng Tech, which comprising the China big tech stocks, up 0.95%, and the H-shares, the HSCI is up 0.88% over here. All right, so rather a positive feedback loop spilling over into the news flow that came out in early today's Asia session is Trump. Trade tariffs, we call it a fiasco again. So Trump, you know that the last 2 weeks he has been rather flip-flopping here and there in his trade tariff stance towards America's key major trading partners, Mexico, China, and as well as Canada, that especially his view on China. Initially, he said that he's in favor of slapping additional 10% tariffs on China. And late last week, he actually flipped his stance, saying that perhaps China, without having any tariffs being targeted, is good for both sides. But however, in today's early Asia session, he actually confirmed with an executive order by targeting 25% tariffs towards Colombia due to sanction and regarding this immigration issue between between Colombia, pardon me, and US. So with this, we call it latest 25% tariffs being slapped on Colombia products heading into US, market participants view this as a potential green light that these trade tariffs targeting policy or hawkish policy towards America's key trading partners, especially against China, Canada, and Mexico, is still alive. That means there's still risk that Trump may suddenly turn the table and flip back towards the hawkish stance, where he could issue trade tariffs orders towards Mexico, Canada, and as well as China in the coming weeks. So that causes the US dollar to rise as well, because we know that the US dollar weakened in last week's trading session, where the US dollar index actually, if you look at the US dollar index over here, let me share with you guys. So the US dollar index last week actually plummeted, right? So this was the daily chart. So if you flip to the weekly chart of the US dollar index, you can see over here. So it actually plummeted, and this it actually closed near a month low, all right, near a month low. So there was this long bearish Marubozu candlestick, all right, breaking below the 20-day moving average, but managed to find support right exactly at the 50-day moving average, which is at 107.50. And this bounce that is being seen right now in the US dollar index, that means i.e. representing dollar strength as we are speaking right now, is due to this potential, due to this what I call green light that is being market view this as a green light, where Trump officially slapped 25% tariffs on Colombia. Potentially this trade tariffs hawkish stance is still alive, and that there's still a risk that Trump may impose trade tariffs officially with Canada, Mexico, where he actually deemed is to come as soon as 1st of February, and most importantly China. We should see how it goes, but that is that created a kind of a positive feedback loop into the US dollar, where we start to see the dollar now rallying across the board, especially dollar CAD is up by 0.54%. As we're speaking right now, based on the 5-day rolling performance basis, because Canada is being targeted in this trade tariffs, we call it a hawkish policy that the Trump administration that wishes to embark over here. Right, and this also, the dollar strengthening, it also created a negative feedback loop into the major US stock indices as well. So as the E-mini futures that are trading right now, where our product is being based on, the Nasdaq E-mini is down by negative 1.8%, whereas the S&P E-mini futures is down by negative 0.9% as we are speaking. So later I'll touch on the intraday technical outlook on the Nasdaq 100 and as well as the US Wall Street 30, and also it also created a negative feedback loop into other Asia stock indices as well, except for China and Hong Kong, because they are being embraced right now by this potential, we call it more stock market friendly policies that the China top policymaker is pushing out right now. So the Japan 225 is down by negative 1.7%, and if you look at across the board in Asia, the STI, which is also considered as a proxy of import international trade, is down by negative 0.3%, and the KOSPI is also down by negative 0.7%, and the TAIEX, which is pretty much a link to US onshoring airline, is down by 1%. Right, so what we could see over here right now is a kind of a risk-off session in terms of the stock indices, except for Hang Seng, because of that stock market friendly policy that the China top policymaker right now is pushing up, that is supporting the outperformance of the Hang Seng index at this moment as we are speaking. And another data I want to share with you all is this undesired state of affairs in the Chinese economy, where at 9:30 a.m. in today's Asia session, the official MBS manufacturing PMI and non-manufacturing PMI data is being released for the month of January. So both of them actually dipped below expectation and underperformed last month figure. So previously the manufacturing PMI was at 50.1. Market is expecting at 50.1 as well. That's for the month of December, but in this month is disappoint. It actually slipped back to a contractionary mode. So for any PMI reading, anything that's below 50 is represent contraction. So it went back into a contraction mode again of 49.1, and the non-manufacturing PMI also inched down below 52.2, heading towards the middle, the what I call that, the thin line of expansionary at 50. So if you look at the services PMI data, in China. Okay, the quite non-manufacturing is actually representing the services activity. So the services activity actually it actually fall down from a 9-month peak of 52.2. So actually previously this is like a blip over here, and now it fall back again. So what is telling us over here is that the Chinese economy internally is still very, very weak. That means there's still risk of a deflationary risk spiral, given this rather lackluster print of the MBS non-manufacturing PMI that fell down to 50.2 in this month, January, from a 9-month peak of 52.2, so it fell to 50.2. So what we could see over here is that there is going to be much more potential stimulus that's going to come out pretty soon. The only key thing is that market wants to hear what kind of amount that the China top policymaker will actually give out, and most importantly, will this stimulus be targeting directly towards consumer sentiment and business sentiment to boost their spending in order to actually get out of this entrenched potential deflationary spiral that is playing out in the Chinese economy right now. All right, so that sum up the news flow and economic data session that I want to share with you all. So before we start our intraday technical outlook on the broad-based cross asset classes, let me expand my screen so that you guys could have a better view of the charts. All right. Okay, good. I think it should be fine. So let us now start with the FX market first, starting with the euro dollar. So still recall that euro dollar on last Friday, we flipped to a bullish stance to look out for that potential mean reversion rebound scenario, and the mean reversion rebound scenario play out as expected and hit our resistance level as we mentioned on last Friday, which is 1.052. And what we could see before the gap down on today's Asia session, that means the dollar strengthening in the Asia session due to trade tariffs being alive again from the Trump administration after Trump officially imposed that particular this 25% trade tariffs on Colombia. So with that, the euro dollar also hit the upper limit of this minor ascending channel as well, which also correspond to 1.052, which is the minor ascending channel from the low of 13th of Jan. And what's interesting over here is that the RSI on last Friday shaped a lower high, so indicating that the upside momentum may have starts to slowly ease off, at least on the intraday basis. Okay, where's my RSI? Yeah, this bearish divergence over here. Okay, bearish divergence, lower high, whilst the price action starts to print out higher high. Okay, so with this bearish divergence and the euro dollar hitting the resistance level at 1.0520, so for today's intraday session, that means only for today, potentially there could be a minor corrective slide taking shape within this minor ascending channel that is still playing out in the euro dollar. So I'll be using 1.0520 as my short-term pivotal resistance level. I will flip to a intraday bearish bias for today for that potential minor corrective decline scenario that may play out. First near-term support zone to watch out will be close to the 50-day moving average, also acting as a support, intermediate support level 1.0460 / 1.0440. Only a breakdown below 1.0440 increase the odds of this potential minor corrective decline sequence, exposing the next support level in near term at 1.090. Potentially below it sees 1.0340 next, which is so pretty much close to the upper limit, the lower limit of this minor ascending channel, and conferencing with the 20-day moving average, I think as a similar support level as well at 1.0340. Only an hourly close above 1.0520 will invalidate today's intraday bearish bias to see a continuation of this mean reversion rebound scenario, exposing the next intermediate resistance level at 1.06 figure, one-time Fibo extension from the low of 13th of Jan, and graphically this minor swing high area of 20th of November and 6th of December. So i.e. in a nutshell, we will be using 1.0520 short-term pivotal resistance on the euro dollar, flip to a intraday bearish bias for a potential minor corrective decline sequence that may play out. Now, onwards next will be its cousin, the sterling dollar. So the sterling dollar also similar hit our resistance level at 1.2475 at this point in time. Also very closely confluence with this downward sloping 50-day moving average. So what you could see over here is that I'll be using 1.25 figure level, which is last Friday swing high during the US session. So 1.25 short-term pivotal resistance flip to a bearish intraday bias for a potential minor corrective decline sequence to play out. First near-term support level to watch will be 1.2370, 1.2370, which confluence with the 20-day moving average, acting as this similar near-term support level as well. Only a breakdown below 1.2370 may expose 1.2230 next. However, if price start to have an hourly close above 1.25 figure level, today's intraday bearish bias will be invalidated to see a potential continuation of that mean reversion rebound scenario to 12570 next, slash this level. The next level will be this, okay, 12610, right? 1.2610, so 1.2570 slash 2610, okay, will be the next resistance level to watch if the pivotal resistance is being taken out on the upside. So i.e., in a nutshell, using 1.25 short-term pivotal resistance, we will flip to a intraday bearish bias stance for the sterling dollar, potentially for a minor corrective decline sequence to play out. Now onwards next will be the Asia Pacific currency against the dollar, starting with the Aussie dollar. So the Aussie dollar as well also managed to find a bit of rejection at the 50-day moving average before trading back lower in today's Asia session. So I'll be using the 50-day moving average. Last Friday we were bullish and it hit the resistance level, which is the 50-day moving average. So from here we'll be using 0.6330 as my short-term pivotal resistance level. Will flip to a intraday bearish bias for a potential minor corrective decline sequence that may unfold. First support level to watch will be 62.55. Only a breakdown below 62.55 exposes 62.16 next, 62.16 next, which also confluence with the 20-day moving average as well. Only an hourly close and a push up above 63.30 short-term pivotal resistance level will invalidate today's intraday bearish bias to see the continuation of this mean reversion rebound scenario heading up towards the key medium-term resistance zone of 63.60/64 figure. So what is this dotted red line? This dotted line here, this dotted line is very important because this dotted line is a former major range support, now turns into a key pullback resistance level. All right, so this is the former major range configuration since the low of 13 October 2022, tested one time, two time over here, and it broke finally on the 16th of December. Right, so this is the Aussie dollar. So up next, what's up next will be the dollar yen. So the dollar yen continues to actually trade in a kind of a sideways range configuration between the 20-day moving average and between the 50-day moving average for now. So what we could see over here is that since it's the trading in the middle of nowhere for today's Asia's session, we will attempt to have a neutrality stance for now because it's not coming close to the 20-day moving average. So neutral for now for today, right? Because on last Friday we will have a bearish bias, so it actually hit the 50-day moving average before trading in a very messy intraday sideways movement on the dollar yen. Okay, let me put it over here. Let me change the color. All right, So neutral between 15715/50 and 15480/50. All right, so only a breakdown of the hourly close below 15450 will potential validate another round of bearish bias for the dollar yen, exposing the next support level at 15320, which is the minor swing low of the 18th of December, and potentially coming close to the 200-day moving average as well. So that's for dollar yen, flipping to a neutrality stance right now since the middle of this, the 20-day and the 50-day moving average. So neutral between 15715/50 and 15480/50 next. All right, so now that's sum up the intraday technical outlook on the major US dollar pair. So now let us now turn our attention to the major stock indices, starting with the Hong Kong 33, or the representing the Hang Seng Index. So you see the Hong Kong 33 going to push up higher, and now has really retested 20th of January minor swing high. So with that, I will have a tightened key short-term pivotal support level for today, which is at 20,000 level, which is also last Friday US session low, and so coming very close to this minor ascending channel support from the low of 13th of January. So using a tightened key short-term pivotal support level for today, pardon me, using a tightened key short-term pivotal support for today on 20K, still maintaining that intraday bullish bias on the Hong Kong 33. Next resistance level to watch 20,520, followed by 20,840. All right, 20,840, this graphical resistance here from 9th of December. However, if price starts to have an hourly close and a push down below 20,000 short-term pivotal support level, we will the intraday bullish bias will be invalidated to expose the next near-term support level at 19,685, followed by 19,350 next. Now onwards, next will be the Japan 225, which is representing the Nikkei 225. So for the Japan 225, last Friday we were neutral. It actually broke below our neutrality limit zone, which is also close to the former minor ascending channel support, and now this former minor ascending support is being turned into a pullback resistance. So we will be using 4010, which is the pullback resistance of this channel, as well as my very tight short-term pivotal resistance level. We will flip back to a intraday bearish bias. Next support level to watch 39,450, 39,180. However, a breakup above 40,000 short-term pivotal resistance level will invalidate our intraday bearish bias on the Japan 225 to see a squeeze up back to retest the still ongoing we call it a medium-term symmetrical, medium-term complex sideways range configuration. All right, late September is still hovering in that late consolidation formation, and even today it starts to shape a failure bullish breakout as well. All right, above the 40,420 mark. All right, so with that, unless we start to see a breakout above 40,420, then the bullish bias may resume on the Japan 225 to expose the next near-term resistance at 4105. So what's 4105? If you go all the way back, is the former minor swing low area of 12th of July to 16th of July. Okay, sometime way back. All right, so that's for the Japan 225. Now, onward next will be the European stock indices, which is the German 30. So the German 30 also hit our resistance level and it starts to pull back. And in today's Asia session, it broke below this minor ascending channel from the low of 13th of January that's been inflicted by Trump's official trade tariffs towards Colombia, where market view is as a risk-off event for stocks, where it means that potentially Mexico, Canada, China may be next that will be officially announced in terms of their still fuzzy trade tariffs plan. All right, fuzzy Trump's trade tariffs plan. Pardon me, a bit of tongue twisting over here. So with that, now let us now head back to the short-term intraday technical outlook on the German 30. So using 21,530 as my short-term pivotal resistance level on the German 30, we will flip to a intraday bearish bias for today on the German 30. So if this German 30 index can't surpass above 21,530, at the end of the day, we may start to see the start of a minor corrective pullback sequence unfolding. First support level to watch will be at 21,240. Below it exposes 21,070, followed by 20,940. Only an hourly close above 21,530 will invalidate today's intraday bearish bias to potentially see the continuation of the impulsive upmove sequence, potentially seeking out the next resistance zone to watch will be 21,680/770, which is being confluenced by a Fibonacci extension clustering level. So that's for the German 30. Onwards next will be the US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 also almost hit our first resistance level at 44,740 on last Friday. So with that, that will be my short-term pivotal support, pivotal resistance level for today. Pardon me. So using 44,740 as my short-term pivotal resistance level on the US Wall Street 30, we will flip to a intraday bearish bias on the US Wall Street for today, potentially for a minor corrective decline sequence to play out. First support level to watch will be 44,130. A breakdown below 44,130 exposes 43,730/43,600 next, which is also confluence with the 50-day moving average. Pardon me. Only an hourly close and a breakout above 44,740 will invalidate the bearish bias, intraday bearish bias on the US Wall Street 30 to see the continuation of its impulsive upmove sequence towards 45.90, which is the current all-time high area /100. Above it, potentially sees 45,500/45,700 next, which is confluencing with a Fibonacci extension cluster. All right, so now what's up next for the Nasdaq 100? So the Nasdaq 100 also can't break above our first resistance at 21,960 and plummet and broke below this minor ascending channel support, and also it gapped down as well. So using this gap down resistance level and the pullback resistance of this former minor ascending channel support turns into a pullback resistance, we will flip to a intraday bearish bias on the Nasdaq 100 using this 21,732 as my short-term pivotal resistance level. Next support level to watch, which is being tested right now, is at this let me read it off. Okay, which is 21,400. Okay, let me adjust a bit. 21,400. Okay, so first support level to watch 21,400. A breakdown below it potentially sees 21,240. Below will be 21,044. So net overall, given this gap down and the bearish breakdown below the minor ascending channel support, it seems to us that there's some form of bearish momentum that has crept back into the Nasdaq 100, at least on the intraday basis. So using 21,720 as my short-term pivotal resistance level. However, only a breakout above 21,732 short-term pivotal resistance, a breakout and a hourly close above it will invalidate today's intraday bearish bias to see the continuation of the impulsive upmove sequence. First resistance level to watch 21,960. If it's being surpassed, potentially it may retest the current all-time high area at 22,130/22,160. All right, so that's for the Nasdaq 100, and also sum up the intraday technical outlook on the broad-based major stock indices. So now let's turn our attention towards the commodities market, starting with gold XAU/USD. So for gold, it actually hit our first resistance last Friday and come close to the current all-time high area at 2,790. So it printed a high of 27,008 27,086. All right, 86, very close to 27,090. So still using 27,90 as my short-term pivotal resistance level. We'll still maintain that intraday bearish. We'll flip to a intraday bearish bias. Pardon me. do watch closely the first support level at 2,760. A clear break below 2,760 may expose the next critical support at 2,728, 2,719. So when price action come close to the 2,728/2,719 support area, look out for any signs of potential bullish reversal candlestick. Why this level is very important? Because this is a former 2-month range resistance. So previously it was trading in the 2 months range resistance since the low of 14th of November. Previous peak of the range is at 2,720, 2,730, and also most recently 2017 of January. So all these three peaks can't break above clearly on the upside, and where it managed to finally break out during last week's session, where Trump's toned down his trade tariffs rhetoric, which is to see weakness in the US dollar, which translate into a positive reaction on gold price. All right, so for today, if it comes close to the 2728, 2719 level, which is pretty much key, this is a key pullback support level. If there's a bullish reversal candlestick form, that means i.e. gold may be on the path of recovery again. All right, so then in a nutshell, I'll be using 2,790 as my short-term pivotal resistance level, which is the current all-time high. Flip to a intraday bearish bias for today for a potential minor corrective decline sequence to play out. Within is a short-term uptrend that is still intact. However, an hourly close and a breakout above 2,790 will invalidate today's intraday bearish bias. Pardon me. Again, a breakout with an hourly close above 2,790 short-term pivotal resistance level will invalidate today's intraday bearish bias on gold to see a squeeze up towards 2,812/2,820, and above it says 2,838/2,840. All this level is being defined by a cluster of Fibonacci extension. All right, because there's no other levels historically after the breach of 2,790 in terms of the we call it a past memory effect. Okay, so that's for gold, XAU/USD. Now, lastly, turning our attention will be the West Texas crude oil. So, West Texas crude oil on last Friday, we have a bearish bias. Why? Because price action failed to break above this minor descending trend line from the high of 16th of Jan. And also on Thursday, it reintegrated back to the dotted red line here. So, what is this dotted red line? If you go to the daily chart over here, this is a dotted let's put it in red as well, so easier to see. This dotted red line is formally the upper limit of this major descending channel range configuration that previously was in place since March 2023. And what's interesting, with the reintegration back in price action of West Texas crude oil, which is on the 22nd of Jan, reintegration back into that dotted red line indicate that the lack of follow through in the earlier bullish breakout, we call it a sequence that was being triggered on last Monday. So there's no positive momentum follow through, and it starts to scissor out. So with this scissoring out of the West Texas crude oil, reintegrating back below the so-called the lower limit or the major ascending channel support, we will maintain our intraday bearish bias stance on West Texas oil. We still maintain it, except that we now use a Titan key short-term pivotal resistance 76.16. We're so confluence with that dotted red line here, and as well as the minor descending trend line that is still in place since the high of 16th of January. Next near-term support level to watch for the 74.40, a breakdown below it sees 73 figure next, which is the minor swing low area of 3rd of Jan and 9th of Jan, and as well conversing with the 50-day moving average. Only an hourly close above 76.16 will invalidate today's intraday bearish bias on West Texas oil to potentially see a minor recovery first step towards the next intermediate resistance at 77.07, followed by 78.75. All right, so i.e. in a nutshell, maintaining that intraday bearish bias stance in West Texas crude oil using a Titan key short-term pivotal resistance at 76.16. So with that, before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? For today, I reckon that it should be a rather quiet session. Okay, so this is the non-manufacturing PMI, except that we may start to see some speeches from ECB President Lagarde at 11:35 p.m. Singapore time over here. So with that, that sum up today's market daily dose. That sum up today's daily dose of market insights. I'm Kelvin here signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.